We're back. Stocks are lower today after the S&P and NASDAQ both hit record highs earlier in the session. Here with Where to Invest right now, Ann Walsh, CIO of Guggenheim. Welcome. It's good to see you.
Nice to see you, Scott.
How broadly do you feel about the markets right now? What's your current view? We're at record highs. We'll just call it that.
Right. So it seems that valuations appear stretched, and I think there is a lot of reason to be thoughtful with regard to equities. But I would say that when I look at the comparisons between now and, say, the dot-com era.
Just say that. Yeah. Well, everybody's weighing in, so let's get your view, I suppose.
So I think where we are right now is we're a little bubbly, but not bubbling at this point in time. We're certainly not at the point in time where we saw the valuations at that time. We have room to run. I think the fundamentals are very different now. They appear very strong to me, relatively speaking, in terms of artificial intelligence and other build-outs that are happening, CapEx, and, dare I say, the benefits of the tax policy with expensing of CapEx and other elements. I think that's going to be very strong, for the future, for stocks.
Some have said, that the key difference, or at least one, from that period of time, is that the money being spent today is from the biggest companies with the biggest and best balance sheets. Do you see it the same way? Does that alleviate some of the risk that might otherwise exist?
Well, I think we have a tale of two economies and a tale of two markets. So that is true that the largest companies with the most access to capital, those that are able to make those kinds of investments, those are going to be driving quite a bit of the market activity, and it's very strong. There's also the smaller businesses, maybe the small caps, which have been slower to react. I mean, if you look at the performance of the Mag 7 relative to, say, the 493 other stocks, it's not quite the same story. But I think the fundamentals, the tailwinds are there to help both markets and, both parts of the market. But at the same time, I think it's going to be more supportive of the larger companies.
You make the argument that markets have fully priced in the outlook for interest rates. What is your outlook for interest rates?
So where we find ourselves today, the Fed finally cut the 25 basis points after having been on pause for so long. We anticipate that there's probably 2 more cuts this year. And maybe we're a little bit more aggressive than some of our peers in believing that there's still 2 more cuts. Certainly with the shutdown, everybody's kind of looking around hoping to find some real data points that we can rely on. But I think that the market indications are there. I think the market's willing to accept that. I think the other element is that the employment numbers, while we didn't get an employment number because of the shutdown, I think they are showing that we are slowing down, and the Fed has real reason to go ahead and continue to cut. We also think that they'll cut into 2026 as well. So the trajectory is for continued lower Fed funds rate into 2026 and a move towards what I would call the neutral rate being lower, perhaps, than some of our peers.
How do we balance a weakening labor market? I mentioned to my prior guest that Carlisle came out with their own study, and they estimate that just 17,000 jobs were created last month, among the weakest results since the economy emerged from the recession in 2020. So I balance that versus, well, it just means the Fed's going to cut more, which people then say, well, don't fight the Fed. So how do I think about both of those? Well,
I think that the employment numbers are evidencing the slowdown in the U.S. economy. And by the way, sort of following on some globally as well. And so when we looked at earlier in the year tariffs and the concern that tariffs would be highly inflationary, at the time I took the perspective that I thought they were more recessionary than inflationary, that they had a slowing impact on the economy. I think that's what we've seen. I think we're coming into more of an equilibrium. At the time, we were also rather a strong GDP, and I think that what we're seeing is that this is sort of normalizing the economy into what I would call sub 2% growth going forward, but very much a steady state economy for the future, which again gives the Fed the opportunity to continue to lower rates, and I think a good story.